So, a very good evening everyone. Welcome back to yet another very exciting session today on the topic of banking systems in India. This is your host CA Ishan Gupta. Let me welcome you all to another very exciting session today. Let us begin our session. Today, that is the banking system in India. So in this session, we're going to talk about an overview, exactly what is the banking system and how it is being operated or created over time in Indian context. So banking system in India, as you might be aware that when we're talking about the financial structure, then banking system plays a very important role. There is this banking system. There are various types of banks that are present in India. We will be slowly talking about them. There are scheduled, non-scheduled banks, regional, that is developmental banks are there. There are private banks, foreign banks, government banks, etc. etc. All these we will be talking about, but we should not forget that the ultimate banking system is being governed by the Reserve Bank of India. That is, Reserve Bank of India, which was formed before independence, is being given all the administration, or it is the apex institution when it comes to the banking system in India. Along with the Banking Regulation Act, read along with the RBI Act, that is RBI Act read along with the Banking Regulation Act. The Banking Regulation Act gives the RBI many rights or many duties to perform in the banking system, but in today's session we are going to only elaborate what is exactly the banking system. Let us come to this chart over here. First of all, broadly there is RBI, that is the apex institution. When we are talking about the banking system, it is the head. Ultimately this RBI decides all the monetary policies. It is the apex institution when it comes to deciding monetary policy, that is how much should the repo rate be, what is the money supply that is going on in the economy, etc. etc. So when banks are classified, broadly it is classified into scheduled banks, non-scheduled banks, developmental banks. So scheduled banks can be further classified into commercial banks and cooperative banks. So we might be aware about various commercial banks over here. That is, let me take a red pen, not eraser, red pen, yes, this one. So you might be aware what we're talking about here is, just a second. Yeah, so there are various public sector banks, private sector banks, regional rural banks, foreign banks are there. And in cooperative banks, rural cooperative banks, urban cooperative, state level, district level, primary agricultural societies are there. Developmental banks of different categories are over here. So in this lecture, we are going to take an overview as to exactly what is the banking system in India. So first of all, there are scheduled banks. So what are scheduled banks? There is an act, there is a law, that is Reserve Bank of India Act 1934. Scheduled banks are financial institutions listed in the second schedule of the Reserve Bank of India, Act 1934. So ultimately, if you look at any law or any act, any law, here we are talking about the RBI Act or RBI law. So there are various schedules attached at the end of the law. The schedules you can say, or certain types of list that is to be followed according to the law. For example, in Companies Act, Act 2013, there is a schedule that is Schedule 3. In Companies Act 2013, there is Schedule 3 that tells us exactly what is the format of balance sheet and P&L. Similarly, the Reserve Bank of India Act 1934, there are various schedules attached at the end of the act, that is the second schedule we are talking about, contains a list of various financial institutions, and these institutions are known as scheduled banks. These can be classified into commercial banks. So what is the ultimate objective of commercial banks? The ultimate objective of commercial banks are to earn profits. That is, they are profit generating or profit motive organizations. The ultimate objective is to generate profits. Okay. What they do is they accept deposits. And ultimately grant loans. You can have a look around yourself. Any bank nearby you is ultimately a commercial bank. All the accounts, all the banks in which we have our day-to-day accounts are commercial banks. So what they do is they accept our deposits in the form of savings or current accounts, and they provide these savings or deposits to industrialists or businesses that require loan at a higher interest rate. So commercial banks accept deposits from the public and provide loans to earn profits. So ultimate objective is to earn profits. They are categorized into four types. Broadly they can be categorized into four types, which is discussed over here. First is public sector banks. That is the government banks. That is what? The government banks. Now what is a government bank? Government bank is a bank in which the majority ownership is with the government. Where the majority ownership is with the government. That is known as a government bank or public sector bank. For example, SBI, State Bank of India, largest public sector bank. Majority ownership is with the government. It can be state, central government, or combination of the two. Then there are private sector banks, HDFC, Kotak Bank, ICICI Bank, and you must have guessed it correctly, where the ownership is privately owned. The majority ownership is privately owned. These can be listed also. For example, HDFC or other banks are listed on the stock exchange. So these banks can be listed also. Majority ownership is with private stakeholder or business entities. There are foreign banks. Ultimately, what are foreign banks? These are ultimately owned by the majority ownership, or there are certain investments by the foreigners. For example, Citibank. These banks have headquartered outside India but operate within the country. They must follow the regulations of both Reserve Bank of India and their parent organizations. So ultimately, any organization they have to follow. Any organization that is working in India, especially in banking sector, have to take license from Reserve Bank of India. That is correct. For example, HDFC Bank. Recently, you might have, let me recap this news. HDFC wanted to govern its banking business in Singapore, correct? So when it wanted to govern its banking business in Singapore, it had to apply for the banking license from the Singapore Central Bank over there. So similarly, when a foreign bank wants to work in India, apart from other regulations also, it also has to take the approval from Reserve Bank of India and follow its regulation. Then there are regional rural banks. As the name suggests, these are those banks that are working in rural areas. Established under the Regional Rural Banks Ordinance 1975, they provide credit for agriculture and rural sectors. So ultimately, what are they providing? They are providing credit for agriculture and rural sectors, that is the backward areas. They are providing finance for these development. They are jointly owned by Government of India, the state government, and sponsor bank. For example, Arunachal Pradesh Rural Bank. So as the name suggests, these banks are there for the development of rural areas. Arunachal Rural Bank is a very good example for this. Next category we're talking about is cooperative banks. Let me take you back to this main slide over here. We have just now talked about what? We have talked about the commercial banks. We have talked about what is a scheduled bank, why we call it a schedule, what is we calling scheduled bank. Then there are commercial banks over here. We have talked about this. Now we're going to talk about cooperative banks. The different types of cooperative banks. What are cooperative banks? So cooperative banks is ultimately when a bank is formed in such a way that the owner is both the owner and ultimately the customer. Also. It is the owner also and it is the customer also. Recently, the limit of accepting deposits was being raised by for certain cooperative banks. The limits for accepting deposits was being raised to 1 crore rupees for certain cooperative banks. If you might be following the news. So cooperative banks are financial entities owned and operated by its members who are both the customers and the owners. The customers are the ultimate owners also. They support agricultural activities, small industries and self-employed workers. So in a way you can say this is a bit of legal structure for the self-help groups. For example, there are customers, they pool in their money and create a entity that is cooperative bank. The ultimate objective of this cooperative bank is to provide funds to their members only. That is, the members who have contributed the money, they provide finance to these members only. So these are cooperative banks. These help in especially in agricultural activities, small industries. That is, big industries can ultimately go to private banks also, but these help their own people. Structure is credit cooperative banks are there. Individuals in a locality form these societies consisting of borrower and non-borrowers interested in each other's business affairs. So this is the lowest category. That is, if you categorize credit, then district level, that is Gautam Budh Nagar, then it comes at state level, you can say at the UP level, Uttar Pradesh level, and there can be national also. It is not mentioned over here. There can be national level cooperatives also. So credit cooperative, it is at the lowest level, local level, you can say at Noida level or something like that. District level, district cooperative banks, for example, again Gautam Budh Nagar. If those people who might not be knowing, Noida is a city. Gautam Budh Nagar consists of many such cities. For example, Gautam Budh Nagar is a broader area and it covers Noida, Greater Noida, or this expressways also, you know. So district cooperative banks formed by multiple credit cooperative societies in a district. Then there is state level. This is simple example at Uttar Pradesh, UP level, formed by multiple district cooperative banks. Next, cooperative banks are divided into two main categories. So cooperative banks, apart from this structure, that is credit, district, state level, they can also be classified into urban cooperative banks and rural cooperative banks, UCBs. We call them UCBs, the urban cooperative banks located in urban and semi-urban areas. Rural cooperative banks are further divided into short-term and long-term banks. As the name suggests, these will be located in rural areas. So hopefully all of you are enjoying this session. And here we are taking a overlap or overview of the entire concepts. So now rural cooperative banks can be further divided into short-term and long-term banks. As the name suggests, short-term loans will be provided by the short-term cooperative banks. Long-term or medium-term loans will be provided by the long-term cooperative banks. So short-term cooperative banks provide short-term loans for crops and working capital to farmers and rural artisans. So let me take an example of a farmer. As you might be knowing, any business, whether it being a small business or a big business, requires finance, and finance can be divided into two categories. That is the day-to-day affairs, that is the working capital, the funds that is required for the working capital, and second is the funds that is required for the long-term purpose. So two types of funds are required. That is, one is for long-term planning. That is, a farmer has to purchase a new tractor or has to purchase a new area or has to invest in certain areas. That is a long-term investment requirement. But for the day-to-day working, that is purchasing the HYV seeds, purchasing the fertilizer, pesticides, developing of water facilities, these are ultimately working capital requirements of a farmer. So short-term cooperative banks provide such short-term loans, that is the day-to-day activities are financed by short-term loans that is provided by these cooperative banks. They include state cooperative, district and primary agricultural credit societies. Rural cooperative banks are further divided into what? Short-term and long-term. This we have already studied. Then long-term cooperative banks are there. As the name suggests, they provide long-term financing, provide medium to long-term loans for agricultural investments, rural industries and housing. So these investment horizon is as compared to the short term, obviously a bit of a long term horizons for the development of rural areas. They include state cooperative and rural development banks, primary cooperative agriculture and rural development banks. Then there is banking system. Let me take you back to the original slide, and from this slide you can pick up exactly what we are covering. This is, we have covered rural cooperative banks, as the name suggests. These are covering rural areas. Urban cooperative, urban and semi-urban are covered. Rural can be further divided into short term and long term. Correct? There are state central, district central, primary agriculture societies, etc. Then there are non-scheduled banks. As the name suggests, non-scheduled. What is scheduled banks? As we studied, the scheduled banks are those banks which are mentioned in the second schedule of RBI Act 1934. So what is non-scheduled? Those banks or those financial institutions which are not referred in the second schedule of RBI Act 1934. Correct? So scheduled mentioned, non-scheduled not mentioned. Simple as that. Now we are going to talk about what are the developmental banks. So let me elaborate this. What a developmental banks does is, a brief history needs to be known exactly how developmental banks came into existence. This history will be taught, this history will be mentioned in the coming lecture, but what is the history exactly? Let me elaborate. So what happened is, India got the independence in 1947, correct? India got the independence in 1947, and after that the main reforms that in India took place was in 1991. Here the independence, India got the independence, and after that the main reforms, the liberalization, privatization, globalization, that is the new economic policy, took place in 1991. After that only there was a lot of coming up of private banks. And before 1947, what happened was, Indian industries or many sectors were totally controlled by the Britishers and was totally destroyed by this. So in this phase, the government thought that it was essential that certain developmental banks need to be, taken into place for the essential reason that certain areas of the economy required more emphasis than the others. तो इससे आपको ये समझ में आ जाएगा what I'm trying to say is, developmental banks were the need of the hour. उस टाइम पे जरूरत था. 1950s, 1960s, 70s, the policies were in such a way that developmental banks were the need of the hour. Our economy just after independence was not in the best of situation to self-sustain. So ultimately government had to come up with certain ideas that development needs to be in a balanced or equitable manner. So came the existence of developmental banks. As the name suggests, every developmental bank had a specific area where they were targeting for the development. So what is developmental bank? Developmental banks are financial institutions that provide long-term credit to support capital intensive projects, which usually take a long time to yield returns and offer significant social benefits. Let me take a small example. What happened was, in 1947, let us, every policy that is being introduced, there is always a reason behind it as to why the policy is coming into existence, correct? In 1947, Indian industries were in the worst of its form. The reason was Britishers completely destroyed Indian industries so that India would be dependent upon British goods. And if you study history, you would get to know, if any economy wants to develop, ultimately the industrial sector needs to grow at a very rapid rate. In India, the industries were set to grow, but every industry, there is also one more problem, that every industry requires finance. What? Every industry requires finance. Setting up of industry requires a lot of time. Along with time, they also require funds. Along with time, they also require what? They require funds. So industries require time, they require funds, after only which they would be able to generate returns. But the Indian banking system at that point of time was not in a situation to support such capital intensive industries or such industries which require a long time period for its investment. So ultimately what happened was Indian government came up with, that is, the developmental banks. One of the developmental banks, let me highlight, Indian Industrial Development Bank of India, IDBI, established in 1964, correct? So as the name suggests, the main purpose of IDBI was to develop industrial sector in India. So as the name suggests, ultimately, for example, SIDBI, Small Industries Developmental Bank of India. In today's scenario also SIDBI is there, and it is working for the development of small scale industries, established in 1989. Industrial Finance Corporation of India, established in 1948. Exim Bank, that is Export Import Bank, established in 1982. So what is the purpose of Exim Bank? Ultimately the purpose is to finance imports and exports, to fund them. National Bank for Agriculture and Rural Development, that is NABARD, established in 1982, that is to develop, to support agriculture and rural development. The main purpose of development banks is to create specific area developments. The name ultimately mentions the purpose. Many of the students are of NABARD preparations also. So what is NABARD preparations? Ultimately the agriculture and rural development, it is an institution. These banks play a crucial role in funding projects that contribute to economic and social development of the country. So no doubt that the objective is profit making, but along with profit making, such institutions, the main objective is to develop, to target a certain area and to develop that area, to provide funds to that area, which a normal regular scheduled bank would not be able to do in a certain scenario. So what is the changing landscapes of banking system? As I mentioned, the banking system has experienced a wide variety of change over the period. So how this change came into existence? There are three phases. As I have constructed a diagram over here, there are three major phases. The first phase was before 1947. The second phase was from 1947 till 1991, and the third phase was after 1991 that we are still experiencing. So before independence, 1947, India was under the control of Britishers, correct? So the policies, the banking system were ultimately controlled by the Britishers. Even the Reserve Bank of India, as we have done in the introductory lectures, was privately owned. After the independence only, it was nationalized, correct? So many banks in the second phase, this is the first phase, this is the second phase, this is the third phase. Many banks after independence were nationalized. That is, the private ownership was taken away and the ownership was transferred to the government. But in today's scenario, that is the third phase. The first phase, Britishers; second phase, nationalization; third phase, that is today. Today, the government is providing more and more liberal policies. That is, foreigners, FDI, foreign direct investment, is allowed in India. More branches are being opened up, more licenses are being provided, more private banks are coming up, small banks are coming up, so that the banking sector has a strong financial, it acts as a strong financial backbone for the country. So what is the evolution? How all this began? The evolution of Indian banking system can be divided into three distinct phases: pre-independence, second phase, third phase. As mentioned, roughly three phases are selected over here. Pre-independence, the Reserve Bank of India was established based on Hilton Young Commission recommendations. So these data or these main points you need to remember. The statutory basis of RBI's operations is provided by Reserve Bank of India Act 1934. RBI began its operation on 1st April 1935. So RBI began its operation on 1st April 1935. This phase saw many small banks with huge failure rate. So ultimately, this was a time when small banks had a huge failure rate, that is, they were starting up and failing. Prominent banks like Bank of Bengal, Bank of Bombay, Bank of Madras merged in 1921. So what is merged? That is, they came into one single banking unit, that is the Imperial Bank of India, today known as State Bank of India. which is renamed the State Bank of India 1955. So how the State Bank of India came into existence? It is ultimately the merger of various small banks, various banks that were in existence before independence. Second phase, in 1949, the RBI was designated as the Central Bank of India, and Banking Regulation Act 1949 was passed to regulate banking activities. The act empowered RBI to supervise bank boards and management, oversee audits, control mergers and liquidations, provide banking policy directives and impose penalties. So ultimately RBI Act 1934 read with Banking Regulation Act 1949. These ultimately provide the power to RBI, to have a supervision, have a control over the banking system of India. So these are various sections that are mentioned over here. If possible, you should memorize the important sections. If not, then you can just have a overview. Section 5B defines banking as accepting deposits from the public and repaying them on demand or withdrawal by check, order, draft, etc. It also defines a banking company as one which conducts banking business in India. So banking companies ultimately which is accepting deposits. Simple definitions are there. Section 6 permits banking companies to lend and borrow money, buy and sell foreign currency, issue traveler's check, buy bonds, execute trust, etc. etc. So many functions are defined in section 6. So this ultimately deals with deposits, taking deposits. This section deals with deposits. This section deals with providing loans and advances, correct? Section 8 prohibits banking companies from trading goods directly or indirectly. So banking companies, once established, it cannot deal with buying or selling or manufacturing of goods. Section 18 says it requires banking companies to hold at least 4% of their total demand and time liabilities. So what is time, demand and time liabilities? Let me explain. As cash reserves deposited by 20th day of every month. This ratio can change. So what is demand and time liabilities? Let me explain with a quick example. So this is a bank, correct? Bank accepts deposit. It is the primary objective of a bank to accept deposit. So deposits are of two types. One is the demand deposit. One is the demand deposit. What is a demand deposit? For example, savings account and current account. The amount is being deposited in the banks and it can be withdrawn at any point of time. Such are known as demand deposits. Then there is another type of deposit that the bank has, that is the time deposits. For example, fixed deposits, FDs, RD. In this, the bank accepts deposits and it repays that amount after a certain point of time along with a certain return, that is interest. These are known as time deposits for the banking terminologies. So there are two types of majority deposits. Demand deposit, where the depositor, for example, I am going to deposit in the bank and I can withdraw the money as and when required, as on my demand. Second is time deposit. I come, I give you the money, and after a certain point of time only I can take the deposit from you. So this is known as time deposit. So demand deposit and time deposit, these act as liabilities for the bank. These are liabilities. Why a liability for the bank? Because bank has to repay that money. It is not the bank's money. The bank has to repay the money back to us on either maturity or on our demand. So this is a liability for the bank. So section 18 is mentioning that, for example, if the bank receives a deposit, can be demand, can be time, of rupees 100 crore, it cannot lend a loan of 100 crore. No, it has to keep a certain reserve with itself, known as cash reserve. It can be kept with itself, अपने पास भी रख सकते हैं, या it can be kept with RBI. There are certain rules on that, we will discuss later. Section 30 empowers RBI to audit the balance sheet of the banking companies. Section 35 allows RBI to inspect banking companies and their branches. So ultimately various powers of authoritative powers are given to RBI. Then what is the changing landscape? Nationalization of banks. What is the meaning of nationalization? There are two types of terms: nationalization, privatization. What is nationalization? Nationalization is when a private company, private ownership is transferred to government. When a private ownership is transferred to government, then such company becomes a government company, that is a PSU, you can say, public sector undertaking. In this case, government bank, you can say. So this process is known as nationalization, where the private ownership is transferred to the government. So nationalization of banks took place in the second phase. This is what we are talking about in the second phase. First phase is gone before the Britishers. It is over. Nothing major to talk about. Second phase we are talking about. 14 commercial banks were nationalized in July 1969. This is an important date you need to remember. To address the need for agriculture, small scale industries and exports sectors previously neglected by the banks that primarily served large industries and business houses. 6 more banks were nationalized in April 1980. So 14 plus 6, 20 banks were nationalized. Formation of regional rural banks, that is the scheduled bank, the fourth category of banks, established on 2nd October 1975, that is on what we call Gandhi Jayanti, birthday of Mahatma Gandhi ji, based on Narsimha Committee's recommendation. So Narsimha Committee recommendation, Narsimha ji. RRB is aimed to serve the unserved rural population and promote financial inclusion. So the main purpose, as the name suggests, we discussed earlier also, the main purpose is to serve or provide banking, developmental or services to rural areas. Apex level banking institutions, that is NABARD, Exim Bank, NHB, SEBI, these are the developmental banks, came into existence in this space. Entry of private sector banks. Despite nationalization, many people still lacked access to banking services. So after the liberalization, if you might be knowing a little bit about economics or Indian economic history, new economic policy was introduced in India in 1991 by the then finance minister Manmohan Singh ji. You might be aware, Manmohan Singh ji was also our prime minister for two consecutive terms, and before that he was also the governor of RBI. According to my understanding, if I am correct, he also served as a governor of RBI. Let me check upon that, but again, he was the finance minister when the new economic policy took place. That I am sure about. Okay, and despite nationalization, many people still lack the access of banking services. Till today also. In fact, if I draw a timeline from 1991 till 2016 also, 2014 also, many people still lack how to use the services of banking system. It was after 2014 or before that, you can also say, but after 2014 the demographic of using banking systems, online payment systems have drastically improved. From 2014, when the new government regime, that is the NDA government, took the power, various banking initiatives have also taken place, financial sector initiatives such as Jan Dhan Yojana. What is Jan Dhan Yojana? You can open zero balance accounts. Ultimately, if you are opening zero balance accounts, what happens is more banking facility is being used by the people. नाना करते भी कुछ ना कुछ तो जमा करवाएंगे ना, 4,000 करोड़, 5,000 करोड़. Ultimately, money cycle starts rotating, money supply in the economy rotates, and the economy develops. Second major event in today's scenario came in 2016 when the internet penetration started in India due to Jio. Along with that, UPI payments also started to skyrocket. Online Google payments and all these. In recent data also, it showed that, recent news also showed that India is set to cross many benchmarks, and it is set to cross the benchmarks when it comes to online payments, UPI payments. So in the second phase, people started to feel, or the economy started to feel, that banking services were not that freely available. So in 1991, the Narasimha Committee recommended allowing private sector banks into the system. Private sector need to be introduced. In today's scenario also, you can see the private banks are more efficient in getting the things done as compared to the government banks. So private banks no doubt are more efficient when it comes to using the resources. This led to licensing of the banks like ICICI, HDFC Bank, Axis Bank, IndusLand Bank and DCB. Further recommendations in 1988 resulting in licensing Kotak Mahindra Bank and Yes Bank. In 1934, a third round of bank licensing occurred, leading to emergence of IDFC Bank and Bandhan Bank in 2015. So the third phase began after 1991, that is after liberalization. Liberalization phase in India's banking sector has been crucial for its growth and progress. Regular monitoring and regulations were necessary to maintain profitability and stability. From time to time, there are various inspections being made, various audit requirements. One of the most heavy audit requirements is in banking sector because public money is involved. Significant reforms were introduced to improve sector's functioning and efficiency. So economic liberalization in 1990s, what steps were taken? Foreign direct investment. What is foreign direct investment? When, for example, investors are there in US, this is India. What is for FDI? When foreigners want to do business in India. When the foreigners want to do business in India, they invest money to start factories or they take up significant portion of existing companies. For example, Hindustan Unilever, for example, Nestle, these are foreign companies, not Indian companies. Hindustan Unilever, it is not an Indian company. Foreign direct investment allowed in banks, leading to entry of private and foreign banks into the Indian market. Technological advancements were introduced internet banking, mobile banking and ATMs, automatic telling machines, revolutionizing banking services. So online banking system, internet systems, ATMs, these were introduced in 1990s. You can say debit credit cards were there. Narasimha Rao Committee formation to ensure the stability and profitability of nationalized public sector banks. The government formed a committee under Shri M. Narasimha. Reforms. The committee played a key role in implementing various reforms in Indian banking industry. As we read it over here, this was only due to the recommendations. One of the key recommendations were given that we need to introduce. See, Narasimha Committee recommended that we need to introduce more private sector banks also. Licensing. The Reserve Bank of India granted licenses to private sector banks. Notable banks include Global Trust Bank, ICICI Bank, HDFC Bank, Axis Bank, IndusLand Bank, etc. So private sector banks were given licenses. Other measures taken were foreign bank branches were opened, halt to nationalization, more nationalization of banks were not done. Equal treatment, that is the government banks and private sector banks were treated equally because both banks are important for the economy to function. Joint ventures were done, allowed foreign banks to initiate joint ventures with Indian banks, encouraging global partnership. So these were the changing landscapes of banking sector. Next, payment banks introduced to provide efficient payment services to public. So various banks, the purpose was to facilitate payments, was introduced. Small finance bank, AU small bank and certain small banks like this, IDFC First Bank. Now it is not a small bank, I guess so, but small finance banks were introduced, established to cater the needs of rural and underserved areas. Online banking systems. As you can see, India is the largest economy, first at number 1 when it comes to online payments. Online banking shifted towards online banking with advent of internet banking and mobile apps for convenient financial transactions. So these are some more concepts over here. To further financial inclusion, the Nashikhet Moore Committee, this is another committee, a recommendation setting up two new types of bank, that is payment banks and small finance bank. These are the banks that we are talking about: payment banks, small finance banks. Payment banks. What does the payment bank do? What does the payment banks do? Just a second. What does the payment bank do? It focuses on financial inclusions, can accept deposits up to 1 lakh. So ultimately what I'm trying to say is, there is a license. For example, how to elaborate this? For example, if I am driving a car, while getting a license, driver's license, there are various restrictions on driver's license also. Okay, if you want to drive heavy vehicles, the license would accordingly be provided. If you want to drive a car, license would accordingly be provided, and so on. Similarly, banks also get different categories of license, and accordingly every license has its limitations also. For example, payments bank focuses on this: can accept deposits up to 1 lakh, cannot lend to anyone, can issue ATM and debit cards, cannot give loans, can provide remittance services, can distribute financial services like mutual funds. So ultimately these all features are there in payment banks. But in small finance bank, focus provide to total banking services to small and medium enterprises, can accept deposit of any amount. There is no limitations. For example, here the limitation is 1 lakh. There is no limitation. Any amount can be accepted. Can lend but largely to SMEs and farmers. So it cannot lend. It can lend but to small enterprises. Can issue ATM and debit card. It can also issue ATM, debit and credit cards. Next, cannot give loans, will have to ensure 50% of loans are in the form of advances up to 25 lakh. Can also provide remittance, can distribute financial services. So ultimately whatever features are here, the positive ones are also here, plus there are additional features over here. So these were introduced. Next, future of banking: expansion of banking infrastructure, physical and virtual expansions through mobile banking, internet banking, telebanking, biometric authentication and mobile ATMs are also present. Significant growth in these areas, especially in the past few years. So now we are talking about mergers. So what exactly is a merger? Let me explain in a simple example. For example, there is a X Limited, there is a Y Limited. If both of them merge into XY Limited, this is known as a merger. There are other forms of merger also. For example, this is let us take a simple example: Vodafone plus Idea led to VI. This is one form of merger. Another form is acquisition. X Limited plus Y Limited is equal to X Limited. For example, Reliance Industries took over Hamleys, but Hamleys ultimately becomes Reliance Industries product. So no change in Reliance Industries. So this is known as, these are different. There are other forms of mergers also, subsidiaries and joint ventures, etc. But what is merger of banks? Two banks coming together to form a new bank. So there are various advantages of mergers. There are disadvantages of mergers also. Pros of mergers: international standards. Small banks can upgrade to meet international standards, including stringent capital adequacy ratio under Basel III. So Basel III was introduced after 2007, 2008, 2009 world crisis that took place due to Lehman Brothers crashing. So these norms single-handedly cannot be entertained by a small bank, but if 2 or 3 small banks come together, they can adhere to such international standards. Geographical expansion: more areas can be covered. Public sector banks can expand beyond their current geographical location. Integrated growth is there. Faster growth can also be there. Merger can lead to more products and services, fostering integrated sectoral growth. Customer benefits: so more banks provide more features. Fewer banks will offer a wide range of products at lower cost. Regulatory ease: monitoring and controlling fewer banks will be easier for the regulatories, that is the RBI. Regulating various small banks is a difficult process, but regulating one or such few large banks is much easier. Reduced government burdens: the central government needs to recapitalize PSBs, that is public sector banks, will be significantly reduced, because ultimately financing small banks is much complicated and harder process as compared to recapitalizing of one large public sector entity. What is recapitalize? That is when government infuses funds in the form of capital to banks. This is known as recapitalization. What are the cons? Industry impact. If a large merged bank faces huge loss or collapses, it will affect the entire banking industry. So if one large bank fails, it ultimately can affect the entire industry. For example, in 2000, it was during COVID 2020, Yes Bank collapsed. It was one of the top 50 companies of India and it collapsed. Stock market in 2020 collapsed. Indian stock market crashed. The two major reasons were COVID and the other was the failing of Yes Bank. Government and finance minister then had to interfere. Branch and ATM closures. So ultimately whenever there is merger, the overlapping works are being eliminated. For example, ATMs, branches, offices are ultimately reduced in urban and metropolitan areas. Jobs, unemployment can be created. Merger could result in job losses due to voluntary retirements and a slowdown or halt in new hiring. So with this, we come to the end of today's session. Hopefully you all like this session. Thank you so much. Give a thumbs up so that I get to know who all are watching my session. बहुत मजा आया बच्चों आप सबको पढ़ा के. We will wait until we meet tomorrow. Bye bye and take care.